list kind of a thing to identify the key aspects of it. Tom is going to dial a little bit deeper, talk about some of the things, and as recent as yesterday and Monday, where some of the portals were starting to open up for some of the small business, minority-owned, women-owned businesses. Talk a little bit about the community banks that are now starting to roll out that process, but understand that it is, as much as you may hear advertising and people talking about the opportunity to do things, it's probably a little bit of an advance to too early of an advanced start on getting the application done, because as you'll hear from Tony Licavoli, by the way, you'll hear from Tony about the interlap or the overlap or intricacies of the credits and the loans and the grants. A lot of times you can do some, you can't do both. You can use some of the cost, but not all the costs associated with both. So because there's so much play between them, if you go out and get a PPP loan on the first day you can, let's say next Monday, you might pass up the opportunity to use an employee retained tax credit, which is maybe more valuable than the PPP. So hopefully today will give you a little bit of insight. It's certainly going to maybe identify areas where you need to follow up, things that you might take advantage of, and get yourself ready for step 2, which is application. How does it work with the ERTC and all of the other things that come with? So with that, I'm going to go into kind of where we are. We know that there was $284 billion that was allocated as part of the CAA, this recent legislation that was passed, for first time and second time eligible borrowing. And we'll go into detail about what that is. So let's take a look at my top 10 takeaways. So expanded eligibility. I don't think there's going to be a lot of interplay here, but I'll say associations, business associations, Chamber of Commerce, those sorts of things, as long as they're not predominantly lobbying, now we'll be able to apply. They were specifically precluded under the first PPP loan provisions. It gave a second opportunity. $2 million, up to $2 million can be borrowed, even for people who applied for and became borrowers under the first round of PPP. You can get another $2 million on a second loan. Number 3, you've got very different restrictions associated with who can apply for the second time. Can't be more than 300 employees. And you must prove at least 25% decreased revenue. And revenue, it hasn't been clearly defined, but from what we're seeing, it's basically what you report on your tax return as total revenue, gross receipts. You must see a 25% decline from any one quarter in 2019 compared to that same quarter in 2020. So Q1 to Q1, Q2 to Q2, 3 to 3, 4 to 4. If you can prove one quarter decline of 25% or more and less than 300 employees, you can get into the second round. The same type of provisions, number 4, the same type of provisions that we saw in the first one, it's 2.5 times your average monthly compensation is what your PPP loan can be. If you are in the NAICS code 72, which is hospitality, restaurants, those sorts of things, they bumped that to 3.5 times. So a good opportunity for those companies that we know have been slammed very hard, hospitality and restaurant, to get a little bit extra in that PPP loan. They also provided a flexible coverage period. Under the first round, it was 8 or 24 weeks. Now it's anytime between 8 and 24 weeks that you meet that definition, you have the opportunity to provide that forgiveness application. Now, this is a key issue, and I think Tom's going to talk about that a little bit, is the flexibility still provides you an opportunity to extend it out at least to the 24 weeks, because in the calculation of PPP and in the calculation of the ERTC, the Employee Retention Tax Credit, you can't use the same dollar of payroll. So if you use it for PPP, you can't use it for ERTC. So you may need a little bit broader coverage period to be able to use the payroll in both capacities and maximize the benefits under both. Next page, number 6, expanded costs. we all knew before that it was payroll, basically, right? Payroll and other non-payroll qualifying costs. It was things like rents and mortgage interest and some of those expenses. Now they've added other operating expenses, including any property damages from public disturbances, some supplier costs, and what we're seeing most often in a lot of small businesses is the cost of PPE, the plexiglass, the masks, the gowns, all the things that come into. Now I get to reopen, but I've got all these added costs. Those will go into the 40%, as you might recall. It was a 60-40. 60 had to be payroll, 40 could be, or 40 or more could be. I'm sorry, no more than 40% could be qualifying non-payroll costs. These costs can be added to that 40%. A big change as well, EIDL grants. Most small businesses saw the $10,000 grant come in as the early parts of the funding, but it was well publicized that in the round one, and when you submitted your application for forgiveness, you could not get forgiveness on that $10,000. So if you got a $100,000 PPP loan, the maximum forgiveness was 90. This legislation changed that. This legislation retroactively changed it to say that the EIDL grant that you received was no longer going to be a reduction from your forgiveness. Now, we don't know how it's all going to be administered because a lot of people have submitted their applications. Tom may have a little bit more insight into that, but we know the SBA knows who got it. We know the banks know who got it. We think that it should be pretty streamlined, and hopefully, I think I heard, Tom, you may be able to confirm this, yesterday, that there was somebody that applied with a PPP forgiveness loan with a reduction for the 10 grand, actually got the 10 grand letter saying it was forgiven. So you may have more insight into that one, but that's what I heard as of yesterday. Simplified forgiveness, there was a provision that up to $75,000 of PPP loans was a quick and simplified 2-page application, basically attesting that you used the funds in the means or the manner in what you told them you were going to, i.e. pay payroll and qualifying non-payroll. They expanded that from $75,000 to $150,000. So we're seeing some of the banks taking a little bit of a step back and saying, hold off on doing your up to 150 until we get all the forms effectively ready and the portals open. If you hear a little bit of pushback and you're under 150, that might be why you're getting that. There were certain changes to the eligibility on companies that were bankrupt or in insolvency situations, whether they could or could not participate in PPP loan. They clarified that in this new act. If you're into that, it's a whole different ball of wax. So reach out to a Raymond advisor and we'll get you the details on that. If you are in a bankrupt situation, you might still be able to apply. And it also required the SBA to issue guidance within 10 days of enactment. Now we're already into that 10 days. And as you'll see, Tom will describe, there's a lot of guidance. There's a lot of guidance that has come out. I think Monday or Sunday, we had an 80-some page document and another 30-some page document that helped describe and put clarification on it, but it didn't. It just started. It just started breaking the eggshell. We're waiting for a lot more to come out, and we'll keep these webinars going to keep people posted. With that, there's my top 10. I'm going to turn it over to Tom and let him dig a little bit deeper into some of the specifics.
Sure, thanks, John. I think what we'll do is we'll kind of do a fast forward for what's really changed over the last 2 or 3 days. Particularly with the newly released rules, the applications, and things like that. But I think we'll start just with kind of a state of where things are from a timing perspective. So the SBA announced that yesterday, there were certain financial institutions that could start accepting certain minority classifications of business first-time applications yesterday. In Michigan and Ohio, I think there was something like each state had 35 or so of these banks and a lot of these aren't traditional banks. They're geared towards the underserved in the minority space. So that's really what's on the docket for yesterday and today. What we're waiting for is sometime after Wednesday, they said they're going to announce what the timing is on the other 90+%, all the other banks, which covers, the majority of people in their applications. So right now we're sort of keeping an eye on what that portal, when it's going to open up to all the banks and when applications will be starting to be accepted. So that is kind of where we're at from a timing perspective. Just some additional highlights from the additional details that came out here in the last 2 or 3 business days. They did provide some additional clarification in some areas. Some of those things were things like the eligibility, not only for businesses that had been in full business, but startups during 2019. There's different quarterly comparisons that you can use to still qualify. You just need to kind of look at the timing of when your business has started in 19 and even up into the fourth quarter, and there's still some ways that you could potentially qualify. The NICS code 72, for all the hospitality, kept a lot of their benefits as far as the per location type measurement of number of employees, and also that they can now take 3.5 times payroll instead of the 2.5 times. We have seen some EDO grants. It does seem like that's going to be a process worked out between the SBA and the lenders. So if you were one of those that already had done forgiveness, already had kind of your loan written off except the $10,000, I think what you could expect is your lender will work with the SBA. The SBA will fund your lender that $10,000, and then they should give you an updated promissory note showing that paid in full. If you originally only got everything paid but that $10,000 or whatever your grant portion was. The other thing that they clarified was that while there's a $2 million cap on the second draw, and there's also a $4 million aggregate for corporate groups. So, if you're a business owner and you've got, a bunch of different companies operating kind of under this corporate group environment, then really there's going to be an aggregate cap, and you may not be able to get every entity in that group PPP relief because of that cap. And so, first time, if you've never applied, obviously there's still this program can still be, done under the first time set of rules. That cap has increased, or that cap still is $10 million. So if you've never applied, you can still go back up to that 10 million. So that, again, just clarifying, the 2 million is the cap on the second draw. I think the other thing is there was also some additional clarity that while the $150,000 loan forgiveness application that was expanded from 75,000 to 150, while it is a fairly straightforward application, they did put some additional language out that there is record retention requirements for 3 to 4 years, depending on the type of document that you'll need to keep. And if you were to be reviewed, you would have to provide that information. So, there's a term that has gone out a lot with, this simplified application, that it's kind of like auto forgiveness. It's not really the case. You still certify that you used funds in the 60-40 split between payroll, that you used it appropriately. And so, you're just, putting your signature to that without providing the information. You're still under obligation to maintain that information and answer those questions if you were to be reviewed in that 3 to 4 year time period. I think another aspect that got some additional clarification was that let's see, I think I lost that note. That the application process is streamlined. So if you're using the same 2019 information, if you're using the same bank, you don't need to resupply any payroll information. All that information, payroll-related information you supplied with your first loan is sufficient. You don't need to resupply it. You will need to supply the proof that you had that 25% revenue reduction from 2019 to 2020. So, that might be as simple as, that 3 months worth of, kind of consolidated income statements for 19 versus 20. Just those 3 months, comparing those 2 years should be enough to supply with your application to allow that to be processed. So up on your screen, you'll see that the Journal of Accountancy has done a nice job sort of putting together a reference, sheet of what's out there as far as interim rules, applications, because there is a specific application for second draw. So you can kind of see that in the middle of the screen. Oh, scroll down a little bit, sorry. I'm sorry, up a little bit. It's up at the top. There's a first draw and a second draw on the application. Yep, right in that section. So, right there, you can kind of see where that second draw is. And maybe why don't we just click on that and open it up, because it is, it's a whole new application. We're not using the same application. And so there's instructions that come along with it, but you'll kind of see on the application, right at the front and center of the page, did you have a 25% reduction? Which quarter? So you fill out the quarter, you fill out the dollar amounts on the application, and then supply your supporting information. So I think, it's pretty straightforward. So I do anticipate this second round being very streamlined as far as information that you need to provide and filling it out, because you're really just, recopying a lot of your original application as far as using all that same payroll information, and you're just certifying the 25% reduction. So I think, those are some of the additional details that we've jumped into, that we've seen that's come out in guidance here, over the last couple of days. And I think the big thing that we're just really focused on is just understanding when the SBA is going to be opening up the portals and allowing applications in. So I think that's all I got in this update. We can jump back to the kind of presentation. And John, unless you got anything else, I think I'll flip it back to you to talk about, I guess one thing, just the EDL program, the Economic Injury Disaster Program. It did get a $20 billion of additional funding. But, I haven't seen on what that means as far as if, those loans were kind of locked in at about $150,000 through the last, 3 or 4 months, maybe 6 months. I haven't seen whether this additional funding will allow for larger loans, second loans, or reinstituting any of the grant programs, and whether any of that changes. So we're sort of just keeping an eye to see what the changes or updates might be with that program, or if it just simply means they're going to do more $150,000 with the $20 billion. So waiting for some more information there. But John, I'll flip it back over to you to talk about a couple more things out of this last stimulus package.
Right. Thanks, Tom. And as Tom alluded to, and I've got 2 more things to add to it, and Tony's going to have at least one thing to go back to my original comment, is you really have to be careful about what and when and how you apply for any types of these grants because of the interplay. So now we've heard of PPP round 1, PPP round 2, EIDL loans, ERTC. Now we've got shuttered venue operator grants. If you qualify, meaning if you were in the theater business or live entertainment venues or some of those where you were actually forced to close, shuttered venues. And if you were if you fall into that category, they allocated a separate $15 billion grant. It's not PPP, it's not a loan, it's an actual grant, similar to the EIDL grants. This may be about another source of funding for you, but you can't do this and the PPP at the same time. So again, if you qualify for this, let's take and it's going to be a little bit slower rollout, so you can't jump into the PPP right off the bat thinking that that's the way to go. More details are to come on that. Main Street Lending is another one. Main Street Lending has been around, but they also expanded it and pushed it out, so the funding will continue. It doesn't say you can't, it won't preclude you from getting a second round of PPP, but one of the things that is very clear in the second round is this need. They specifically say that you must have a need to apply for the funding. In the first round, need was a little bit broader based. It was based on uncertainty. Everybody had some uncertainty associated with their business, with all the state shutdowns and the regulations and the restrictions. And as we go into the winter of 2021, we still have that uncertainty, but does that equate to need? And we're still waiting for the FAQs to come out to give us more guidance. But does Main Street, even a bigger question, if you get a Main Street lending loan, does that necessitate your need? Does that mean that you're all taken care of? So more to come. It's just another illustration of 2 more things that you might not think of, but could have a big impact on your first or second round of PPP. Let's go into the next one. I think we go to Tony, right? Yep, Tony, I'll let you take over.
All right, thank you, John. So we're going to wrap things up today with a discussion on the individual and business tax provisions that were included with the CAA. And we want to focus on the PPP treatment, tax treatment, as well as, what John had brought up, the retention credit and the interplay between all the new programs. And, depending on time, end with talking briefly about what the results from the Georgia Senate runoff election could mean for tax policy going forward. So getting into the individual provisions, we have another round of stimulus payments that are being sent out or have been sent out at this point. They aren't as generous as the first round, so it's been cut in half to $600 per individual. It was $1,200 under the CARES Act. And you also received $600 per child, so it was about $100 more than under the CARES Act. And one thing to keep in mind, just like with the CARES Act, is the stimulus payments aren't guaranteed for everyone. It does actually phase out if your income's above a certain threshold. And it's $75,000 for singles, $150,000 for married filing joint returns. So that information is based off of 2019 tax return information. So there is a chance that you may have qualified under the CARES Act stimulus program, but your income, because they in most cases use 2018 tax return income, but your income rose from that over that 1 year period, and now you no longer qualify, or your stimulus payment is reduced even further because they are using 2019 tax return information now. The second item on there, the student loan payment thing, I do want to mention this because so this was created under the CARES Act, and it basically allows you to contribute, slightly over $5,000 to your employee as wages to your employee for them to cover their student loans. And it's treated as wages, but they're exempt from taxes for the employee, and they're deductible for the employer. So it's a really good program to think about implementing for your employees. This under the CAA, it was extended another 5 years. So we know we have 5 more years of that. And, with all the talk about student loans right now, I can easily see this program being not only extended or made permanent, but also expanded as well and increasing that limitation. So it's a way to help your employees pay off student loan debt, and they get the benefit, the tax advantage benefit of that as well, and you get the deduction as well. So a really good program to look into. Now, going on to the next slide, charitable contributions. The only one thing I want to talk about here is you can take up to a $600 deduction if you don't itemize your charitable contributions in 2021. It was raised by $300 if you're filing a married filing joint return. And really, the bigger item on there is that the income-based limitations for charitable contributions are, again, lifted in 2021 as well. So you can contribute, as far as a cash donation, a significantly higher proportion or higher amount than you could in 2019 or 2018. The next item on that slide, the extension on repayment of the deferred employee payroll tax, and the key word there being employee. So this was the executive order that President Trump had issued somewhere in late third quarter last year, maybe early fourth quarter, that allows employees to defer their Social Security tax, again, employees. So, most, every business I've come across has not, they've never actually adopted this deferral program for many reasons. But, if you as an employer did adopt this program, it is the extended due date has been moved from April until the end of 2021. So the one thing to point out here, this shouldn't be confused with the employer Social Security tax deferral that was part of the CARES Act, where it basically allowed you to defer through the end of the year the employer portion of that Social Security tax amount. Those payments are still due at 50% at the end of 2021, and the other half due at the end of 22. So those payment dates have not changed. It's only the employee side. Moving on to the next slide, some other provisions on here. The medical expense threshold for utilizing those as itemized deductions was made permanent at 7.5%. It was scheduled to go up to 10%. Looking down that list, for teachers, the $250 deduction that you've always been able to get has now been expanded to include personal protective equipment, PP&E. The non-business energy credit was extended through 2021. So this includes purchases of like energy efficient appliances. And then the last item on there, I do want to mention that flex spending accounts, your FSAs, or I'm sorry, FSAs have been the rule where you're allowed to roll those balances over. Those have been extended, so you're not going to lose those balances at the end of 2021. Now, those are the individual provisions, business provisions, which again, really want to make that the focus of our discussion today. Number one item on there, and the biggest item I would say that came out of the CAA, maybe outside of the retention credit changes, is the clarification on PPP loans and specifically their tax impact. So go back to March in the CARES Act. Inside of that statute, it clearly said that forgiven PPP loans would not be includable in taxable income, meaning you don't have to pick that up as an item of gross income. But what it didn't do in the statute was address the associated expenses, like your wages, like your utilities or your rent or whatever you used in forgiveness calculation. So without any congressional guidance, the IRS had to make a decision on the treatment of those, and they chose, based on what they thought was good law, to basically say that those expenses would not be deductible on your tax return. And if you had a $100,000 PPP loan, basically what the outcome would be that is you'd be paying somewhere between 20% and 40% in taxes on that loan due to the loss of those associated deductions. So Congress didn't like the IRS's interpretation of this, and even on a bipartisan basis, they've been saying since April, or really since May, that they didn't agree with the IRS's interpretation. This wasn't their intent, and they were going to fix this. And we expected a change to come, and that change did come with the CAA. And it basically, no interpretation needed, because it said that expenses funded with your PPP loans are going to be deductible on your tax return. So it overrode the IRS's position on this. And, last week, they issued another notice basically saying our interpretation of this is no longer valid. We are now following what the CAA says, what the statute says, that these expenses are deductible. So we know now that income is not taxable from the forgiveness, and now we know that expenses are not deductible. Now, the CAA also
Correction, they are. Hang on one second. You said not deductible. They are deductible.
Oh,
just want to make sure it's clear.
Sorry, yes, they are deductible. Income is not taxable.
Got it. Exactly.
So thanks, John. So the CAA also clarified that there would be no negative impact on a taxpayer's basis for your S corps and your partnerships. So since the loan forgiveness will increase basis because it's tax exempt income, and the deductions will reduce basis, and they are deductible, this would be a net to basically a net effect of zero in that case. Now, the last bullet point on that section is there are a couple of issues on timing. Since the basis increase doesn't happen until 2021 when you do receive that forgiveness. But we're hoping the IRS does release some guidance on that. It's going to be in very limited scenarios where this is actually going to impact you. Now, the last item on that slide, the EIDL grants and SBA loan payment assistance. So the EIDL grants and the SBA loan payment assistance granted through the CARES Act is basically going to get the same tax treatment as the PPP loans, which means, again, no income due to the loan assistance, and then your expenses paid are deductible. And this item on here was actually somewhat good news, because unlike the PPP loans, the CARES Act never stated these items wouldn't be taxable. So this change wasn't necessarily expected, but it's really good news for anyone that has received, especially the SBA 6 months of SBA payment loan assistance. Really good news to know that that's not going to be a taxable event to that taxpayer. So moving on to the next slide, a couple of other provisions on there. Business meals are going to be fully deductible in 2021 and 2022. So under the previous rules, business meals were only 50% deductible. You're now going to be able to fully deduct these expenses. This only applies for 2021 and 2022. So unless that's extended, it's going to go back or revert back to that 50% threshold. They did say that it has to be paid to a restaurant. I guess keep that in mind that we don't exactly know how they define what a restaurant is, if you use like cafeteria services and stuff like that. So keep that in mind that may be one of those items that's still hanging out there on what meals are truly 100% deductible versus which go back or stay with the 50% item. But we don't know the answer to that yet right now. Second item on there, the Families First Coronavirus Relief Act, the FFCRA. Those are the associated paid sick leave and paid family leave credits. These are extended until March 31st of this year. I do want to point out that the mandatory requirements for providing this were not extended and the capped amounts were not increased. So there's a chance that businesses may have used that potential credit at this point already. The last item I do want to mention on this slide before we get into the retention credit is that the work opportunity tax credit, because it is a credit that is often missed and can be definitely very beneficial. This was extended through 2025. It's really been one of those credits that's sort of been hanging out there every single year that we're always wondering whether or not it's going to extend it or not, but they did extend it now instead of just a single year. Actually, I think they extended a couple of years last time, but now we clearly have this credit through 2025. So this credit is something that you receive for hiring certain classes of workers that are defined in the statute. So it can include things like, certain welfare recipients or certain government assistance recipients, ex-felons are on there, veterans. There's a whole bunch of other categories that basically would apply to this credit. And where we see this utilized a lot is in industries that have higher turnover than normal. So I know we have clients that take it in manufacturing. We see it a lot in retail. The most common thing that I think we see it in is in our food service industry, franchises, restaurants, stuff like that. And really, it's any business that relies on sort of entry-level workers or hourly wage workers. That's who can benefit the most from the WOTC. So just note that was extended for several years. So if you don't utilize it and you think you fit into one of those categories I just mentioned, it's definitely worth investigating to see if it could benefit you. So now let's move on to the retention credit. On top of the PPP loan deductibility on the expenses, this was the next biggest item from a tax standpoint that came out with the CAA. And I think before we get into some of the changes, we probably need to talk about a little bit of background on the retention credit, because most people aren't aware that it was created with the CARES Act and aren't aware it existed because they utilized PPP loans, which prior to December made you automatically disqualified for the retention credit. So a little bit of, again, background on what the credit is. It is a refundable payroll tax credit. You can go up to 50% of qualifying wages paid by an eligible employer. And it did apply for wages paid from March 13th through the end of December. So it was temporary because it expired at the end of 2020. But as we'll discuss, it was extended into 2021 and it was enhanced as well. So sort of defining some of those terms, we said it only applies to an eligible employer. Well, to be an eligible employer, you have to basically meet one of the two tests that are defined on that slide there. So number one, well, you have to be carrying on a trade or business. So I think that's a pretty fair, pretty straightforward question that, hopefully you know whether or not you are carrying on a trade or business. But the second item on there is you have to meet either a government order test, which means you have to have operations that were impacted by a government order. So in Michigan, we've had extensive set of government orders dating back to March. The other test that you can meet, you don't have to meet, it is an OR test, is a 50% reduction in quarterly sales, and you compare that to your 2020 quarterly sales compared to the prior quarter in 2019. So again, you don't have to meet both of those tests, you just have to meet one of them. And let's talk a little bit more about the government order test, because the gross receipts test is pretty straightforward. It's pretty easy to measure if you have the 50% reduction or not. You're probably doing a similar calculation for the second round of PPP loans as well. Now, the government order test is the one where there's a lot more nuances, and it's very open to interpretation. So the statute itself, which is, basically a sentence, all they say is you have to have, operations that were impacted either fully or partially by a government order, and a COVID-related government order. So, I think there, just looking at some examples here of what we've come across, or, restaurants, in Michigan have been shut down to a certain extent since March. Now, you could always do, you can do takeout ordering, but for a long period, the insides of the restaurants were shut down, and it was relaxed a little bit, and then it went back down to how it was. So for that restaurant, even though they still can do takeout services, they clearly have a partial interruption of their business by having that government order. So that's a very easy case to say that a restaurant probably meets the government order, at least in Michigan, from the beginning of or March, I think March 18th was our first date of our government order, through the end of the year. Now, you also have other types of businesses on that side that were deemed essential and were basically omitted from any of the restrictions that were placed on it by government orders. And they would not meet the government order test. There's some exceptions, of course, but the only way they'd be able to be eligible for that credit is if they met that 50% reduction in gross receipts test. So that's what makes an eligible employer. The next thing is what wages qualify. And that's really going to depend on your full-time equivalent count or employee count. If you had 100 or fewer employees, it's very simple. All wages that were paid during your qualified period are considered qualified for the credit. Now, if you're over 100 employees, you have a much more limiting set of rules, a restrictive set of rules. Only wages that were paid to employees who are either furloughed, so basically they're not providing services to you, or if it's some type of reduced hours, but are still being compensated for their full wage. So you can think of that, if you're over 100 employees, as wages paid to your employee for not really providing you any services. Now, originally under the CARES Act, looking at that last bullet point on there, is that you were not allowed to claim the retention credit if you took a PPP loan out. It had nothing to do with forgiveness. The mere fact that you took out a loan disqualified you for the credit. So that was eliminated. And if we can go on to the next slide, that restriction was eliminated. And not only was it eliminated, it was made retroactive back to 2020. So discussing some of the CAA changes, first of all, the credit was extended through June 30th, so through the second quarter. So again, we no longer expire at the end of 2020. And then again, the PPP loan recipients are eligible to take that credit, not only in 2021, but retroactively back to the first day of that credit, which was March 13th of 2020. So that means, and we've come across so many opportunities here where clients can go back and businesses can go back and get that credit on wages that you've already paid in 2020. Now, like John said, there is a lot of interplay between all these programs. And the biggest takeaway from this is you can't double dip. You cannot use wages that you used for PPP loan forgiveness to also claim that retention credit on. And there's a lot of uncertainty on how this is going to actually work. And really looking back at 2020, and we definitely need some guidance from the IRS on some of the ordering rules in these calculations. And I'll talk a little bit more about that in a second, but I want to talk on some 2021 retention credit enhancements too. Now, the only change that applies retroactively back to 2020 that we discussed is the fact that you can take it with a PPP loan. These enhancements that I'm about to talk about are only applicable to 2021. So the first thing is they increased that credit rate. It went from 50% to 70% of your qualified wage amount. And now also it's gone up to 70%, but it's now not on a per year basis, but it's on a per quarter basis. So what that means is the maximum credit you can take per employee is now $7,000 per quarter per employee. In 2020, it was maxed out at $5,000 for the full year per employee. So it's gone up, significantly with the enhancements in 2021. The next thing on there is they made it easier for you to be able to be eligible for the retention credit. So the gross receipts test, again, as we talked about under the old rules in 2020, it was at a 50% reduction. Starting in 2021, you only have to be able to prove a 20% reduction in your gross receipts. So in theory, a lot more companies will be able to qualify if they can't prove they were impacted by a government order, because you can always use the other test if you can't qualify under the gross receipts test. And then the last item on there, the threshold for that qualified wage determination was increased to 500 employees. So again, under 2020 rules, it was 100 employees. Now it's gone up to 500 employees. So a lot more wages are going to qualify for people who are between that 100 employee count and 500 employee count. And the last bullet point, some of the logistics on actually going about claiming the credit are still, they weren't well defined in the statute and they're still open. We're really hoping the IRS does release some guidance on the actual process of getting back some of that 2020 credit. But the biggest area right now that we're coming up against is a lot of businesses have already filled out applications and applied, and in many cases received forgiveness using a full 24 weeks of payroll, even though they probably in many cases didn't actually need 24 weeks of payroll. A lot of banks just require that you report that, and a lot of, for simplicity, a lot of people just put that on there. And what we don't know, and this is talking about 2020 again, is does the fact that you reported those wages on a PPP loan forgiveness application, does that automatically disqualify those wages? So we know that we can't double dip and double count. We can't use both, but do we have that flexibility to sort of pick and choose what wages we really used on that PPP loan application if we already applied for forgiveness, as long as we can prove that we're not utilizing the same dollar of wage for both the retention credit and the PPP loan? And right now we don't have that answer. So that's kind of one of the biggest open items hanging out there for people that have already applied is in regards to the 2020 retention credit. So I'll wrap things up. If we can skip down, let's skip down to the Biden tax proposals, because I do want to talk just for a minute on these. So again, we had the Georgia runoff election and the Democratic wins in the Senate. So just spend a minute, not really discussing a lot of the specifics of the proposals, but just sort of my thoughts on any potential change or potential significant tax increases that are coming down the road. This is, outside of maybe PPP loans and retention credits, this is, the up there in the amount of questions that we received over the past week. So, I think when it comes to significant tax increases, it's probably not likely going to happen this year. And I'd say there's probably two big reasons behind that. Number one, it's just logistical. It takes time to write tax legislation. Even if it is on a, even if it's not on a bipartisan basis, there's still negotiations that take months and months and months to do. So to actually draft up new tax legislation, again, this is not something you do in a month. This is something that can take a half year, a full year. I mean, if we go back to 2017, where really the Republicans drove the tax legislation in that year, I mean, that process still took well over a year. And if you really want to go back, I mean, it took a decade to be able to pass that. So legislation takes time to draft. The second thing is that, as probably everyone knows, there's very slim margins of majority in both the House and the Senate. And really in the Senate, the tiebreak, it comes down to the tiebreaker, right? Having the vice president vote one way or the other if there is straight party line legislation. So I guess I don't know if I'd be convinced that too many senators right now have a desire to make significant tax policy decisions during COVID. Because I think, regardless of what party you're on, there is still a big concern about the economy right now and its potential, the COVID's potential lasting effects on the U.S. economy. So, with those two caveats on there, I think, it's probably still a good idea, and I would strongly recommend, thinking about tax planning, especially when it comes to your estate and the timing of capital gains. So, exiting or entering businesses, because I do expect those to be, targeted items over the next 2 years at least. And, if we're again going to narrow it down to what groups we think are going to be the focus of tax increases, well, we have a pretty good guide from the Biden tax proposals. And number one on there is going to be corporations, especially if you decide to offshore and sell back into the U.S. We think those will be significant targets. And then the next one is really for anyone making over $400,000, because that's what the Biden campaign has basically said they're not going to raise taxes on anyone under that amount. So, using that logic, going the opposite way, there's a good chance they want to raise taxes on anyone making over that amount. And their specific platforms indicate that as well. So whether or not they settle on $400,000, I think, clearly if you're in that income bracket, you will be a target of any increases that come. It's just whether or not those come over the next year, or maybe it be into the second year of the Biden administration. And really the next item is for any high net worth individuals. If you have taxable estate, it's really a good time to look at your estate, do estate planning, consider gifts, stuff like that, because that's very low hanging fruit for anyone who wants to raise taxes. The estate tax is one of those items where it's a pretty easy target to be able to do. So I'm not going to go through all the bullet points here. I think as we ended our last presentation, I think the one thing to say is that, the CAA brings along a lot of taxpayer-friendly changes, and that's obviously a good thing. What's going to come in the future, we don't know, but we definitely see potential for tax increases. So I'll leave you guys with the same takeaway as I left the last group that we discussed. But tax policy has been very unpredictable over the past 5 years, and I think we expect that to continue over the next 5 years. So I think good tax planning right now, spending the time to do that is going to basically continue to be a very important aspect over the next couple of years. So with that, I think I'm going to turn it over to either John. I think John, for the Q&A. Do we have anything?
Yeah, I'm gonna actually ask Tara maybe to fill in real quickly. I've got to jump off for a 1 o'clock presentation. I hope Tom and Tony can hang on to answer some questions, but I think it's pretty clear As we've seen, who would have thought it would have been so difficult to accept grant or stimulus money? We see the complexity. We understand the moving parts are going to be consistently brought to us over the course of the next few months. Our recommendation is stay close to your business advisor. If you're a small business, there's so many different opportunities. Make sure they're part of your team and helping you guide you through the path of which one, which option, what makes the most sense, taking advantage of all the tax laws. Tony did an amazing job of covering all of the many, and there's still many intricacies in each one of those. But if you're not taking advantage of them, you're leaving money on the table, and this is more important time to be trying to find sources of revenue than ever before. So take advantage of those. And Tara, I guess I'll leave it with you. And I didn't see any chat questions, but I'll let you guys open the mic. And I apologize for having to jump off, but I've got round number I don't know how many we've got of these, Tom. Maybe this is the sixth one, but I got another one starting at 1 o'clock I got to jump on. So I apologize for the departure, but you all have a great day and enjoy the rest of your week.
Thank you, John. Okay, who has the first question for our excellent presenters? I didn't see any come through the chat, so if someone intended to send one through the chat, we did not receive it. So if anyone has a question, I would be fine to unmute and ask your question. And if not, if you think of questions in the future, I know that you all know how to get a hold of me. I would be happy to pass your question along and make sure that that question has been asked and hopefully answered. And otherwise, I guess I'm going to wait just a moment. I don't want to rush you all if anyone has a question. I'm going to make you ask a question. No, but thank you guys for being so attentive. Thank you, Tony and Tom, for the presentation. And I will make sure John knows as well. And certainly, again, if anyone has questions, I know that they'd be happy to answer them. Thank you guys for participating in our first virtual IMA meeting. And we do plan to have another meeting in February. So you will get information from me in the near future on how to sign up for that particular meeting. I do expect it to be a little bit different format as the IMA is giving us a different format that we have to use. So look for that coming up. And otherwise, if you need anything in the meantime, please get a hold of me. And good to see and hear from some of you that I haven't seen in quite some time. So thank you. I think that's it, unless anyone has a question.
All right, thanks a lot.
It. Thank you,
Yeah,
everyone.
thank you,
Have
everyone.
a nice day.
Bye.
Bye, thanks.
See ya.